The first thing that would break wouldn't be armies, it would be markets. Long before a single soldier landed on Greenland, before a runway was seized or a harbor secured, the global economy would already begin reacting. Trading screens would flash with sudden price changes, volatility would rise across multiple asset classes, risk spreads would widen in places that, on the surface, appear to have nothing to do with Greenland at all. Insurance premiums would climb almost immediately. Shipping rates across the North Atlantic would rise. Energy markets would turn volatile. Currencies tied to global trade and risk appetite would start to wobble. None of this would happen because something had been destroyed. It would happen because uncertainty had entered the system. This is how modern economic shocks actually begin. Not with explosions or dramatic images, but with repricing. With insurers, traders, and investors quietly deciding that operating the global economy just became more expensive. And Greenland sits in one of the worst possible places on Earth for that to happen. At first glance, Greenland looks economically irrelevant. Its population is small. It has almost no manufacturing base, no major financial centers, no consumer market, no stock exchange. On paper, it doesn't look like a place that should matter to the global economy at all. But markets don't care about population. They care about flow. They care about the movement of goods, energy, data, capital, and confidence. And Greenland sits directly between North America and Europe, along one of the most important economic corridors in the world. Transatlantic shipping routes pass nearby every day, carrying food, machinery, industrial components, and consumer goods. Aircraft carrying high-value cargo and time-sensitive freight cross overhead. Beneath the North Atlantic, undersea data cables move financial transactions, communications, and digital services that keep the global economy running in real time. Greenland does not generate value the way a city does. It regulates value the way a valve does. And when a valve becomes unstable, everything downstream feels it. This is why even the idea of military action near Greenland does not stay a military story for long. It immediately becomes an economic story. In finance, risk does not need to materialize to matter. It only needs to become plausible. The moment an invasion scenario is taken seriously, insurers are forced to act. They do not wait to see what happens. They cannot afford to. Maritime insurers reassess exposure across the North Atlantic. Aviation insurers reprice polar and transatlantic routes. Reinsurance firms pass those higher costs down the chain. Insurance is one of the quiet foundations of global trade. When it rises, it acts like a hidden tax on everything that moves. Shipping becomes more expensive. Air freight costs increase. Energy transport costs climb. And those costs do not stay at sea or in the air. They move into supply chains. They move into producer costs. They move into consumer prices. They move into inflation. Energy markets react in the same way. Not because oil fields or gas terminals are under attack, but because predictability has weakened. Traders widen spreads. Volatility increases, hedging becomes more expensive. Even small disruptions start to matter when routes feel politically fragile. Energy markets do not wait for shortages. They price uncertainty. Then comes capital. Capital is patient when rules feel stable. It becomes cautious when those rules look like they might change. As Greenland turns into a military question, investors begin asking uncomfortable questions. Will trade routes remain reliable? Will insurance remain affordable? Will alliances hold under pressure? Will this escalate or drag on for years? And most importantly, what happens to risk premiums? When risk premiums rise, borrowing becomes more expensive. Governments pay more to finance debt. Corporations face higher financing costs. Long-term projects are delayed. Marginal investments disappear. Growth slows, not because something collapsed, but because confidence quietly pulled back. This is where many people misunderstand economic shocks. They imagine sudden crashes. But the most damaging shocks are slow and structural. They do not feel like disaster. They feel like friction. Everything still works, just worse. Everything still moves, just slower. Everything costs more. Greenland is uniquely positioned to introduce exactly that kind of friction into the global economy. Any operation there would be slow by nature. Weather dictates tempo, ice restricts access, distance drives up cost, which means uncertainty does not resolve quickly. An unresolved uncertainty is poison for markets. This is why saying Greenland could sink the world economy does not mean collapse. It means something more realistic and more dangerous, a prolonged drag, higher costs, persistent volatility, permanently elevated risk. And this is only the first layer of the problem. To understand why Greenland triggers economic shock so quickly, you have to understand how modern markets think about geography. Markets do not look at maps the way generals do. They do not ask who can conquer a place. They ask what happens if that place stops behaving normally. Greenland is one of the few places on Earth where normal is already fragile. Its value is not in what it produces, but in what it connects. Greenland sits at the intersection of three critical systems: trade routes, air corridors, and strategic infrastructure. None of these need to be destroyed to cause disruption. They only need to become unreliable. The North Atlantic is not just water, it is one of the most economically dense spaces on the planet. Goods moving between North America and Europe pass through or around Greenland's vicinity every day. So do aircraft carrying pharmaceuticals, electronics, industrial components, and high-value cargo. Above the ocean, transatlantic flights use polar-adjacent routes because they are faster and more fuel-efficient. Below the ocean, undersea data cables carry the digital backbone of the global economy. Greenland does not host these systems the way a port city does. It overlooks them. In finance, oversight matters almost as much as ownership. The moment Greenland becomes unstable, routing assumptions break. And when routing assumptions break, cost assumptions break with them. A container ship rerouting to avoid perceived risk burns more fuel, takes longer, and requires higher insurance coverage. Multiply that across thousands of vessels and the effect compounds. Freight rates rise, delivery times lengthen, inventories thin, prices creep upward. The same logic applies to air freight. Longer routes mean higher fuel costs, tighter schedules, and higher prices. For industries that rely on speed, pharmaceuticals, electronics, financial services, those delays translate directly into lost efficiency and higher costs. None of this requires a blockade. None of this requires combat. All it requires is doubt. This is why Greenland is so economically sensitive. It is close enough to matter, but remote enough that stabilizing it quickly is extremely difficult. Markets understand this intuitively. That is why they react faster here than they would almost anywhere else. There's also the Arctic dimension. For years, global markets have quietly priced the Arctic as a future opportunity. New shipping lanes, energy exploration, mineral access, long-term logistics advantages. Those expectations are fragile. They rely on one assumption above all others: stability. The moment Greenland becomes militarized, the Arctic stops being a future growth story and becomes a risk zone. Investment dries up, insurance costs surge, long-term planning collapses. When expectations collapse, markets do not merely adjust downward, they reverse. Capital flows out, projects stall, governments step in to replace private investment with public spending, usually at higher cost and lower efficiency. This is how a localized security issue spreads into a global economic problem. And this is still only part of the story. Market shocks get attention, but costs are what do the real damage. Once uncertainty settles in around Greenland, something far more dangerous than volatility takes over. A cost structure that turns time into losses and presence into burn. Every serious operation in Greenland is logistics first. Not strategy first, not firepower first, logistics first. There are only a handful of usable ports, only a few runways that matter. Vast distances between everything, almost no redundancy. Every movement depends on fuel, heating, maintenance, transport, and power. From a financial perspective, this is a nightmare structure. High fixed costs, limited scalability, no flexibility. When something goes wrong, weather delays, mechanical failures, supply disruptions, costs do not rise gradually, they cascade. Fuel consumption spikes, maintenance cycles shorten, personnel costs increase as rotations accelerate. None of these costs taper off over time. They intensify. This is the opposite of economies of scale. It is negative operating leverage. The longer an operation continues, the more expensive each additional day becomes. From a financial perspective, Greenland behaves like an asset that never reaches break-even. There is no point where sunk costs are recovered and operations become cheaper. Every extension deepens losses. Markets understand this. That is why uncertainty around Greenland does not calm investors. It alarms them. Once capital is committed, exiting quickly becomes difficult. Weather closes windows. Infrastructure takes time to dismantle. Capital becomes trapped. And trapped capital is the most dangerous kind. It cannot be redeployed. It cannot be reallocated. It cannot earn returns elsewhere. Instead, it bleeds quietly. The pressure does not stay local. Governments fund operations alongside everything else. As costs rise, public investment slows, debt issuance increases, markets adjust expectations downward, growth weakens. This does not cause panic. It causes stagnation. Then there is alliance risk. Greenland is not just geography. It is a fault line. It is part of Denmark, a NATO member. Any conflict there forces markets to confront the possibility of alliance strain at the core of the global system. Markets are extremely sensitive to this kind of risk because it is hard to hedge. You can hedge oil prices. You can hedge currencies. You cannot hedge a loss of trust. When trust weakens, bond yields rise, credit tightens, liquidity thins. Equity markets underperform, not in a crash, but through persistent weakness. This is how geopolitical stress becomes financial contagion. And once trust erodes, it is difficult to restore. At some point, risk stops being temporary and becomes structural. Markets adapt to a new baseline, one that is permanently more expensive and less efficient. Supply chains shift from efficiency to redundancy. Investment demands higher returns. Growth slows everywhere. This is how the world economy gets sunk without collapsing. Not through catastrophe, through drag. Greenland does not need to be conquered to matter. It only needs to be crossed, because once predictability dies there, the cost is not measured in territory. It is measured in years of slower growth, higher inflation, and persistent instability. That is the real deterrent. Not armies, not firepower, but the global economy's intolerance for uncertainty. And once that line is crossed, the price is paid by everyone,